The live price for PTL Ltd, NASDAQ PTLE, is currently $0.26, reflecting an absolutely massive intraday movement of plus 40.35% today, which is an extremely volatile spike that demands immediate attention. Now, the common expectation for a stock trading in the sub-dollar range, especially one that has seen a dramatic drop from a 52-week high of nearly $16, is that this kind of move is just noise, a fleeting, low-volume blip in a stock destined for more pain, perhaps an aggressive short-term squeeze driven by retail sentiment you see discussed on investing sites or on platforms like Robinhood. That is the standard narrative. But here is the critical insight you might not have anticipated. This massive swing, while clearly high risk and speculative, given the price point, is happening immediately after the company reported its first half fiscal year 2025 results, which, on the surface, contained a significant psychological win that is fighting against a much more concerning underlying business trend. The expectation is dead stock. The reality is a sudden, powerful re-rating attempt based on a nuanced financial filing, which is exactly the kind of tension that creates opportunity and risk in the market. This powerful upswing on PTL Ltd stock, pushing it to $0.26 from its previous close, is directly reacting to the reported net income figure. For the first half of fiscal year 2025, the company actually reported a net income of $1.21 million, which is a staggering 277.5% increase year over year. In the world of heavily battered stocks, a positive triple-digit net income gain is an immediate flag for speculative investment. This is where the tension begins. The market sees net income up 277.5%, and traders, particularly those using accessible online investing platforms or seeking investment help with their individual brokerage accounts, jump in. However, the deeper reality is that this impressive net income figure was almost entirely manufactured by a single non-operating event, a $2.4 million reversal of expected credit loss provisions. When you strip that out, the core operating picture for PTL Ltd actually looks quite soft. Revenue fell by 13.4% year over year to $43.56 million, and critically, the gross profit margin was sliced in half, dropping from 2.3% to a thin 1.3%. Operating expenses, particularly staff and professional fees related to their U.S. listing, actually soared by over 63%. This is a textbook case of a financial report showing a strong bottom line that masks a weaker top line and operating core, a classic expectation versus reality mismatch driving this tremendous daily volume. The volume, in fact, at over 17 million shares is substantially higher than the 30-day average, signaling genuine, albeit speculative, accumulation. This is not just a few trades. It's an intense burst of trading energy, typical of low-float situations. The common cautionary belief about PTL Ltd is simple. It's a microcap stock, one with a current market capitalization hovering just around $6 million, which has been in a severe long-term downtrend, recently receiving a NASDAQ listing compliance notice for its market value and share price, a clear existential threat to its trading status. Investors generally believe this indicates a lack of fundamental viability and an imminent delisting. I challenge that common ground by pointing out the capital raising activity and balance sheet movements. While institutional ownership remains minuscule at less than 0.5%, the company successfully completed a $7.14 million public offering of ordinary shares just a few months ago in April 2025. Coupled with the financing proceeds reported in the latest filing, this implies a concerted effort to fortify the balance sheet and address the NASDAQ compliance issues. For a company trading under $1 and facing compliance threats, raising capital is a necessary and difficult hurdle, and the fact they executed it indicates a short-term survival instinct is active. This is why self-investing platforms can be so dangerous in this area. They make it easy to buy, but interpreting the true meaning of these financial nuances, like a credit loss reversal boosting net income, requires the kind of deeper look you might seek from professional investment or fidelity-style analysis, which is not always readily available for stocks this small. Zooming in on the daily trading action for PTL Ltd, the volume spike is the dominant technical factor. The rapid ascent from the previous close suggests a high degree of buying pressure overcoming persistent short interest, which sits at a modest but notable 1.45% of the float. The stock has been trading near the lower end of its 52-week range, and the abrupt move creates a violent technical reversal that could attract momentum buyers who use simple charting signals, further exacerbating the upward move. However, the resistance levels, particularly the psychological 0.30 and 0.50 marks, will become immediate battlegrounds. The daily swing is so exaggerated that any profit-taking, which is highly likely given the nature of speculative sub-dollar stocks, will lead to equally sharp pullbacks. This is why anyone considering a position here, perhaps testing the waters through their individual brokerage or a platform like SoFi Invest, needs to recognize this as pure tactical trading, not fundamental investment. The trading is highly technical, driven by the juxtaposition of a fear of delisting and a recent, very positive, but non-recurring net income headline. The overall technical rating is still poor for the long term, with the stock below all major moving averages on a longer time frame, but the short-term indicators, like the Relative Strength Index (RSI), are screaming momentum for the day. This duality makes the situation incredibly tense. Let's discuss the company's core operation, something often overlooked during these hyper-volatile swings. PTL Ltd is a holding company that operates primarily as a bunkering facilitator in the marine fuel logistics space, serving the Asia-Pacific market with maximum revenue derived from Hong Kong. In simple terms, they facilitate the purchase, sale, and delivery of marine fuels, like low and high sulfur fuel oil, to vessels like container ships and tankers. Their business model is essentially asset-light brokerage and trade finance. They arrange the vessel refueling, manage the logistics, and, importantly, extend trade credit to customers. They act as the middleman. This model makes them extremely sensitive to global trade volumes and the underlying commodity price of marine fuel, which is a low-margin, high-volume business. The 13.4% decline in revenue reported in the first half of 2025 is a direct signal of this sensitivity, indicating a drop in sales volume. This is the reality that the current stock price spike is trying to ignore. In a high-volume, low-margin business, a slight rise in the purchase cost of marine fuels, which the company noted, can decimate the already thin gross profit margin, which is exactly what happened with the 52% drop in gross profit. Their ability to manage trade credit risk is paramount, which is why the $2.4 million reversal of an expected credit loss provision is so significant. It's essentially a one-time gain from a previous fear of default not materializing. This is a positive for the current accounting period, but it is not a sustainable stream of operating profit. The institutional picture for PTL Ltd is almost blank. With an ownership percentage this low, the stock's volatility is almost entirely in the hands of retail traders and high-frequency trading algorithms reacting to headlines and technical moves. This contrasts sharply with a massive, widely held blue-chip stock like Apple stock or Nvidia stock, where institutional activity, often visible through filings from institutions like Fidelity Investments or the activity within Schwab Intelligent Portfolios, drives the majority of price discovery. This lack of institutional anchor on PTL Ltd means the daily price movements are prone to overshoots in both directions, making it a high-risk, high-reward environment. If you trade on Robinhood or an online investment platform, you're competing directly with sophisticated rapid trading programs that feed off this exact type of financial filing and subsequent high-volume price action. This is the wild side of the investment world, far removed from the stable, long-term approach of utilizing Fidelity ETFs or Fidelity mutual funds for core portfolio growth. Looking toward the future for PTL Ltd, the path is fraught with both critical risk and potential high beta opportunity. The expectation is that the positive net income headline will fuel a short, aggressive pop, perhaps testing the 0.30 or 50 mark before the fundamental reality of declining revenue, razor-thin margins, and the looming NASDAQ compliance issue reasserts itself. The ultimate reality hinges on a few catalysts. First, the NASDAQ compliance itself. If the company fails to meet the minimum requirements, the stock will be delisted, which would almost certainly be catastrophic for the share price. Second, the fundamental operating environment in the Asia-Pacific marine fuel market. An uptick in global shipping and trade, coupled